What's going on, everybody? Welcome to this week's Markets in Focus. It's 5:22 p.m. Eastern Standard Time, December 17th, 2023, and a lot has happened over the last few weeks. If you haven't been following our content, you know that we have been very, very long off of the late October, early November pivot, and we continue to think that we should remain long. But there is a lot of sector and industry rotation, market cap rotation under the surface, and we're going to take the next 10 minutes to dive into that, and at the very end hit you with a new trade idea. Without further ado, let's go ahead and get into this. We look at the 1 week return here. IWM, small caps. This is completely different from what's been going on the entirety of the year, where the mega caps and the large caps, specifically the growth mega caps and large caps, have really outperformed. Think your Mag 7, your Apple, Microsoft, Amazon, Tesla, etc. Now all of a sudden we're seeing a lion's share of the flow pressing towards some higher risk areas, specifically the small cap space. IWM being absolutely battered over the last few months for sure, actually hitting a new 3-year low, still stuck within a range, right? We've been stuck within a range for about 2 years here, but here we are pressing into the upper bounds of the range, which we'll see in a second, up 5.5% on the week. That should absolutely have your attention. Bonds outperforming as well. We have a couple guys inside of TTI that are up massively off of the late October ad on that TLT position. Congrats if you are one of them, 600% plus on some of those ads. It's absolutely insane. We do think there's an opportunity here to potentially buy new TLT positions above the 200-day moving average. We will look at that in a different video. There's an opportunity to continue to go long bonds, and we do think that we should continue to go long bonds. The Qs knocking on, as a matter of fact, we closed at an all-time high on Friday. We're knocking on an absolute all-time high sometime this week, up 3.36. Basically everything that could go up and should have gone up went up. It's absolutely nuts. The only thing that slightly underperformed was Bitcoin, but after the crazy run that it's had over the last few months, can anybody really complain? We're long, we're strong, we're happy, we're making a bunch of money in this type of market environment right now, and we don't think that this is going to end anytime soon, but it will shift. Like the area of focus will shift, and we're going to go through that in 1 second. We're going to go into U.S. sectors really quick on the 3-month. Normally we go to the year-to-date, but there's so much going on right now that I think it's important to understand where is strength in the market specifically over the last 3 months. It's not always only going to be growth. Not always going to be the Mag 7. As of right now, tech is up the most over the last 3 months, and a lot of that has to do with a semiconductor space pressing into all-time highs, but also a software space pressing into new 2.5-year highs. It's important to understand that it's not just semis that are working well for tech, which we'll see in a second, but look at some of the newcomers. Industrials at an all-time high. Financials pressing up into a 2-year high. Other areas of the market are starting to outperform SPY that traditionally, at least this year, have not. They've underperformed. So that opens up new opportunities and avenues for us as traders to go and buy those specific names to give us some exposure outside of just the Mag 7. If we go to the industry standpoint, over the last 3 months, regional banks, who would have expected that, right? If you've been following our content, you are in a key trade with us right now. We're going to talk through that in a second on TradingView. But right now, regional banks absolutely beasting everything, followed by home builders, who had that, right? Home builders actually one of, if not the top performing industry group other than semiconductors this year, once again showing us that as interest rates are falling, people want to own home builders. Semiconductors holding up there well, and there's that software space. Look at all of the areas of the market over the last 3 months that are outperforming SPY. These are different opportunities for us to get long. Gold miners, internet names, metals and mining, a lot of this stuff we haven't really been very long this entire year, opening up for us, right? Let's go to the factor analysis because we hinted at the fact that market caps are rotating, and they are. We were talking about the fact, wrong one, qualitative there. We'll talk through that in a second, actually. But over the last 3 months, it's not just buy Mag 7 and wait. From a trading standpoint, the opportunity cost of owning that stuff is starting to get relatively high because other areas of the market are outperforming the Mag 7 right now. Does that mean you should be dumping your Magnificent 7, your mega cap growth names? Absolutely not. If you're in trades, especially if they're free, continue to let those ride as long as you have expiration or time on your side. But should you be allocating your scarce, finite capital towards new positions in an area of the market that is underperforming? It's not necessarily going down, but underperforming. It's a question you have to ask yourself right now. Small cap value, outperforming. Mid cap value, outperforming. Small cap core, outperforming. Different types of areas are outperforming the S&P 500 right now. So once again, that gives us an opportunity to potentially open up new positions in different areas of the market. I'll give you a hint. A lot of this is going to be regional banks, small and mid-cap financial names that are starting to run, etc. right? So we're going to start looking at that type of stuff. I just showed you qualitative. I want to show it to you one more time. Just look at this really quick and look at the types of names that are starting to run, specifically IPO. We're going to look at this in a second on TradingView. This is a fun little way to think about where is risk in terms of sentiment in the market. Ask yourself a question. Do you think IPO would be outperforming SPY over the last 3 months if the market thought we were going to break back down, potentially hit new lows, a new corrective phase, etc.? IPOs are generally going to be the more high risk areas to be buying, mostly because they don't have a lot of price history in the back end. A lot of sell side analysts don't have targets for them yet. So if people are going out and buying this stuff, it's really because there's a lot of risk on sentiment in the market right now. And we're about to see that. So let's actually shift over to TradingView really quick. Oh, excuse me. I do want to try. I want to post one thing actually. It's always one tweet, right? One tweet per Markets in Focus here. And I want to, highlight Steven Straza, one of my favorite technicians on Twitter. Give him a follow if you're not already following him. But he very eloquently posted a chart here that says 44% of stocks are overbought in the S&P 500 right now, as at its highest level on record. The only other readings above 40% were in June of 2003 and June of 2020. And if you're not aware, June of 2003 was coming out of the dot-com bubble low, and obviously June of 2020 was coming out of the COVID low. These are very, very, very bullish readings. Very bullish readings. Most people think of overbought and oversold conditions as extremes that have to mean revert. Absolutely not. As a momentum indicator, as a trend follower, overbought scenarios can continue to stay overbought for quarters at a time. And Steven Straza here showing us that these extreme overbought signals going back at least over the last 23 years have always been met with incredible runs to the upside. So before anybody posts their RSI indicator and says, well, you got to be careful because RSI is telling us all of this stuff is overbought, that's a good thing the last few times it's been up here. We'll see if that continues. So we're going to talk through a few key themes here. The Dow Jones being number one, all-time high, right? All-time high Dow Jones Jr. Good job. That's all I got to say. If you've been following our content, you know that we have been long and we've been expecting the Dow to hit all-time highs. I personally expected it to happen in the first few weeks of January, but here we are. All-time high Dow Jones. If you're a boomer or if you have your parents that have been involved with the stock market, this is the index. I mean, this is the most popular thing that people used to look for, and this is a great indication of overall market health. The Dow Jones having a nice blend of different types of sectors, as opposed to SPY and the Qs that are obviously tech dominated. Tech is, I think, the third largest sector within the Dow Jones. So really showing us that the total market is giving us a huge push here. Market breadth is expanding like crazy. It's an absolutely great time to be long the market. The Qs, I just said, on an absolute basis, from a closing standpoint, all-time high close on Friday. Congratulations. The candlesticks, though, showing us that there has been intraday price action up near 407, 408. So although the Qs this weekend, all-time high close, congratulations. Until we get up towards that 408 area, just wait till you see the difference in headlines when the Qs actually trade above all-time highs officially. And SPY within a spitting distance here of all-time high. What am I trying to tell you here? If you're not long and you're looking for the market to fall back down, a double top, etc., you're in the wrong camp. I'm going to tell you right now, if you want that mean reversion trade to the downside, there is so much locked up money sitting on the sidelines that is going to be required to buy higher that taking the short side trade here is statistically disadvantageous. I'm not saying that it can't work. I'm not a wizard. I have no idea where the markets are going to go. I have a bias that's long. All I know is if you're looking to short here, you are looking to short one of the strongest trends we've ever seen. Literally, we have never seen a 52-week low into a 52-week high quicker in small caps ever in history. This is the biggest turnaround in IWM in history. Like we said earlier, small caps are outperforming, up 5%, I believe, on the week. And here we are pressing up into the upper bound of the range here that we've set over the last 2 years. This is the key chart moving forward, at least for the next 4 to 6 weeks. It's this small cap space. Everybody wants to own the Microsofts and everything. Let them. They're going to be fine, I'm assuming. Small caps are where people are going right now and expecting outlandish returns in the short term. Go back a couple videos and watch our talk through on the January effect, which is this idea that from the middle of December till about the beginning of February, small caps outperform. Historically speaking, that absolutely is true. And here we are right now, December 17th, with IWM pressing up into that 198 to 200 area. This is the opportunity for small caps to finally break out of their 2-year range into a stage 2 breakout, right? The Wyckoff market model, Stan Weinstein stage analysis, and make a new run up towards this 225 to 240 area. If that happens, there's going to be a lot of opportunity to be long those small caps. So look at the small caps. Let me go ahead and paint a picture here for you. If you know anything about high beta and low volatility stocks, right? High beta stocks obviously are going to be moving at greater than the normal market index beta. For example, the S&P 500, we're looking at stocks that move greater than the S&P 500. Generally, these are going to be more risky areas. Generally, these are going to be more tech, growth, etc. Names that typically are more risk on, if you will. And then we can look at the low volatility names, right? So both of these ETFs, you can steal them, SPHB for the high beta and SPLV for the low volatility. These are more of your defensive nature stocks, right? These are the names that aren't going to move a whole lot to the upside or downside. They're going to be a little bit more resistant to trend changes, etc. Generally, people are looking to buy these in risk-off environments because they don't go down as much as the broader market, right? So if we take a ratio chart of SPHB and against SPLV, what do we see here? This is a ratio, right? This is a relationship, of high beta stocks against low volatility stocks. And what are we seeing here? We are seeing a breakout right now showing us that the market is valuing high beta stocks greater than low volatility stocks. Low volatility stocks are anything realistically around the 2 or less percent ADR range. Generally speaking, it's a nice little, if you have your ADR indicator anywhere, it's a nice little filter. You're going to want to be looking at higher beta names right now. The market right now is rewarding higher beta names. What does that mean? IWM names, small cap names, Russell 2K names, small cap, mid cap, etc. Go and buy the stuff that's breaking out. I'll take it one step further. ARK. Everybody wants to shit on ARK. Totally fine. But guess what? ARK is breaking out into a stage 2. This is a stage 2 breakout incoming above 5152 area on ARK. What does that mean for the general market, the broader market sentiment? You don't have to love it. I don't have to love it. I do love it. These names that typically are held within ARK are higher beta names. They are typically within the Russell 2000, and they are starting to break out as a group. What does that mean? Go and own the names that are going to allow your cash to work in a better environment than holding some of the more defensive names. Higher beta names are starting to break out, and we're seeing entire sector and industry groups break out with it. So go and look at some of the shit stocks, excuse me for swearing, but some of the shit stocks in ARK that nobody wants to actually own, but from a trading standpoint are offering incredible risk to reward. We're going to look at one in 1 second. The last chart I really want to focus on here is your IPO. Right, we're just looking at this for a Koifen. This is yet again another potential stage 2 breakout in IPO. You don't have to go and buy the ETF itself. But what does this mean when the market is finally going to let risky, newer IPOs break out into a stage 2? It's time to go and find these and own them from a trading standpoint. And we're in a lot of these already, right? One of the biggest trades that we're in that could potentially make our year that we opened up at the beginning of December is this ARM trade, right? We entered it off of the 56.5 breakout a month ago at this point, and we've been adding in on every single pullback. This is going to be one of the biggest trades, I believe, that we make together as a group in 2023, and it directly comes from that ARK IPO higher beta mindset. This is the type of stuff that needs to be in your watch list right now. Okay, so let's go ahead and look at 2 trades that we took together within TTI and then also in public, because some of them are coming up on key areas that we need to be managing. Uber, if you took the Uber March 60s back when we were breaking above that 48.5, 47.5 area, you're up huge into an all-time high. This trade should already be free. For those of you that follow us, we close half of our position at 100% to turn it risk-free, and then we're only playing with house money after that. Please make sure you're doing that if you're taking the trades that we take, because that allows us to remove all risk from the trade and continue to let the trade move in the direction that we expect up until the price targets. Well, up here near 64, right? We tapped near 64 on Friday, 63.53. We are going to be reducing our position size at that 64 area because that was the original price target up here off of the all-time high spot, right? So we're going to reduce, we're going to cut about a quarter of our position as a group, and then we're going to have another quarter of the position left to run up until the March expiration if we want. Obviously, we have another 3 months before we have to manage that, so good job if you're currently in that, but please watch that 64 area. We're also looking at potentially adding a new tranche of Uber up at 64, but that's for another video. Key is a recent trade that we put out, but we've been in this for quite a while. Key here, we bought it off the 12.5 pivot. If you bought the contracts that we were in, I believe we bought the March 15th. This should be a free trade. Everybody that took Key around the same spot as us should be up anywhere between 100 to 250%. This trade in particular should be completely free. If we get up towards $15, which we almost did on Thursday, we want to once again take a quarter of position off and let the remaining 25% of the trade continue on up for as long as the trend wants to allow us to go up. But both of these trades, Uber and Key, great trades, should be free at this point if you took the same ads as us, or excuse me, the entries as us. So all stress is out of the trade, and now it's just, let's see how good this thing is actually going to go. The last trade here I want to go through is a trade that we're starting to open up this upcoming week, right? Monday, currently Sunday. So we're looking at this above 1225, a hood trade. This is an ARK, this is an IWM, this is a higher beta style trade, right? So this fits all three of those things. It's a mid cap at 10 billion. It's a high ADR at 4.96. There's virtually no volume up and over this $13 area, which is what we like to see in terms of the VRVP. Lower odds of overhead resistance off of the stage 2 breakout, right? 200-day moving average is starting to slope up. Would wish it was just a little bit more, but that's okay. Price is up and over it. RSI is screaming that the market wants it. Volume is there. This is a pretty nice setup. This is a very good setup here for a potential stage 2 breakout in a high beta mid cap name that happens to be just within the same ETFs that we want to be trading, right? That IPO, that ARK, etc. So if we go to Tasty Trade really quick and we look at the contracts, not ARK, excuse me, Hood, we are currently buying the May 15s, I believe. The May 15s, a lot of this volume is us right here because some people did start getting in late last week. But here we got the May 15s. We have 58.8 IV with a 47.6 IV rank, so we can still buy calls. You don't need to buy call debit spreads here, and we don't want to into a stage 2 breakout anyway. We don't want to cap the potential profitability on this because what we've seen over the last 6 weeks is that a lot of these things break out and continue to run for an obscene amount of time. We don't want to cap that if we don't have to. $15 calls right now, over 3K open interest, 394 volume. You can get them under $1, right? Get them under $1. It's not a bad idea for 152 days of expiration. It surely beats these fucking weeklies that dipshit day traders buy. Just stupid. Buy some time and let this stuff like work itself out. You're going to make a hell of a lot of money when the trades actually make sense and they start running instead of trying to time every top and bottom on a 1 minute candlestick. Just don't do that. All right. Buy Hood. The May 15th is what we're going to be buying, but only over 1225, right? Over 1225. We don't want to buy these contracts if they're over $1. We really want to get these under $1. Above 1225, we're going to be targeting $15, $20, $25. Just follow the fibs up. If at any point this particular trade trades underneath 1125, we want to cut the trade, get back whatever we can. And obviously, if or when it gets up and over 100%, we want to close half to take all risk out and let the rest of the play continue up to the price targets. All right, guys, my name is Hamilton. I'm here at the Trading Initiative. That's how we are focused over the last 4 to 6 weeks. High beta, small mid-cap names are probably going to outperform. At least that's what it looks like. And so we are positioning ourselves in a bunch of them, including this Hood trade. If you like this idea, please comment below. If you hate it, comment below. Let me know what you think. Please like and subscribe if you like this type of content. It really helps me out, and I'll catch you in the next video.